Hey guys, welcome back to the channel. So, if you're feeling like quitting stocks right now, then you're in a pretty natural spot because the markets have been very, very volatile. And if you're in a position where you're looking at your portfolio and it's all minus, it's all in the red, it is natural that you feel like quitting stocks is the way to go. However, in this video, what I want to do is I just want to provide a little bit of context around what's going on. And I want to reference back to an article that I came across maybe about a week or so ago that's been playing on my mind because I believe that some of what that article has found through research kind of explains where we are right now. And as always, I'm going to give you my tips, my guidance on what I think you could do and maybe should be considering doing if you are in a position where quitting stocks really does seem like an option that you're more than tempted to take up. So, with that being said, let's get going. So, if you are new to investing, and I mean you've only just started investing over the last 12 to 24 months, then you haven't been here before. You don't know that markets go up and go down. In fact, social media has probably told you that markets go up all of the time. And you may have not have considered the downside risk that you're carrying when you invest into the stock market. So one of the things that I like to talk about a lot because I think is important. I think we get too carried away with how much we can make versus how much we could potentially lose. And I think oftentimes with the conversations that are being had right now with investing, the focus isn't about mitigating the downside risk of investing, which is what I essentially preach. And I've got a whole chapter in my course that speaks specifically about that. But this is an article by CNBC, and this is a research piece, a survey piece that was done by Schwab's in the United States. And I think they have some really key data points in here that I think explain why there are so many people out there at the moment who feel like quitting stocks because they weren't fully aware of what they're coming into, especially from an experience point of view, anyway. And in sharing this with you, I hope that you are able to perhaps look at your situation, see where you are, see how you're feeling. And if you are feeling like quitting stocks, hopefully this gives you some confidence. And we'll move on to a little bit around, what has the market done historically and maybe some key considerations. So this is the article here. And the first thing I want to highlight is really this 15% of current retail investors began investing in 2020. So this is off the back of the pandemic, essentially. So pandemic kicks in, furlough, job losses. That's when everything really kicked off. I mean, in the States, it's slightly different because they were looking at stimulus checks, so on and so forth. And think the situation is a little bit different on the ground. However, here in the UK, you can still draw parallels. You can still draw comparisons to that. The fact that most people have started investing over the last 12 months when things got a little bit desperate, when extra cash was actually needed. And in this instance, it's really important to acknowledge that maybe investing was started and implemented from the wrong place. It was out of the need to get an emergency fund, for example, is one of the things that I've come across quite a bit. Now, in this article by CNBC, we actually get into some of the numbers behind the survey that they did. And interestingly, I want to draw parallels to this because I think that you may be in a position where you fall into one of these groups. And the section that I want to highlight, there are numerous on here, but this is the first section I want to highlight. And that is generation investors. This is what they're calling this cohort of people who started investing in the last 12 months. Now, generation investors has a median age of 35 compared to the pre-2020 investors whose median age is 48. Swab said more than 50% of generation investors are millennials, 22% are Gen X, 16 are Gen Z, and 11 are baby boomers. Now, baby boomers are the older generation. I've certainly seen that in my interactions that I'm having more people who are in the baby boomer generation who are learning how to invest now and take this as part of their interest. But some of the bigger data that I really want to highlight are the market sentiments that they've actually uncovered. And this is one key thing. So this contrasts opinions and views on the stock market with generation investors and pre-2020 investors. And this is the bit that I really want to highlight. Optimistic about the US stock market. So 73% of generation investors were optimistic versus 63% of pre-2020. Um, think that the stock market will increase in value in 2021. 57% of generation investors versus 44% of pre 2020 investors. Plan to invest more in the stock market, 43% versus 20%, and plan to spend more time managing their portfolios, 30% versus 19%. Now, we live in a different time now where information is available to people, and that is a great thing. However, I have to question within this around, well, pre 2020 investors, we don't know what they mean by that in terms of the experience, but there is an argument to say, certainly from my point of view at least, that maybe the pre 2020 investors actually have lived through market crashes. I've lived through 2007, 2008, when markets do actually correct and are in full knowledge that the markets are cyclical, which means that the markets typically run on a cycle. And to be completely honest, we are way overdue a market correction at this point in time. And you look at the sentiment around the thoughts about will the markets increase in value? Who's optimistic about the markets, who's going to spend more time in managing their investments, how many people are going to be investing more into the stock market. Generation investors are more bullish in that regard than pre 2020 investors who are likely going to be a bit more pessimistic, a bit more pragmatic in their approach because they've lived through market cycles before. However, with that said, though, there is a little bit of a shift that this article has found in the investment approach amongst the generation investors. And this is different from where they were in 2020 when they just started out to the outlook this year in 2021. And this is the data point really that highlights a lot of this. And it's about the attitude. So buy and hold for long term gain. 56% of generation investors in 2020 were taking that stance. That has shifted significantly to 72% in 2021. In terms of trade for short-term gain, well, actually, in 2020 it was 44%. In 2021, that's 28%. And that's down quite a bit as well. And I wonder whether this is because of the realization that actually markets are volatile. Markets do go up and down. And I wonder whether this reinforces the thought of I feel like quitting stocks, or whether we see the paradigm of that shift between or to investing more for the long term. And one of the things I wanted to do in this video is just highlight the impact of the market on your investing. Because if you're a first time investor, yes, you can get caught up in the details of the markets are volatile, but really, what is this all about? As you guys know, I'm a long term investor. I really do believe that that's where wealth is created. And even when you start to look at the markets generally, and in fact, the biggest market on the planet, which is the US market, which is where everybody really wants to be invested, you can't but help but look at the S&P 500 and take notice of how many good years it has had versus bad years. I mean, literally between the years of 1929 when the S&P 500 was created to now, the market has only been down 29 times. That's 29 out of 94 years that the S&P has been in existence. So when we talk about investing being a long-term game, yes, past performance is no indication of future performance, but the track record is there to reaffirm that investing really is a long-term game. And so if you're finding yourself at the moment where you're looking at your portfolio and you really do feel like quitting stocks because all of your portfolio is down, let that data point be a source of inspiration and a source of comfort to you to know that actually this is a long term strategy that you need to be taking and you need to be considering. And I'm sorry that you may not have been told that at the beginning where you started, but this is something that you know now to be true based on data. You can look at any developed world market, even if you look at the UK market, it's exactly the same. Over the long term, the markets return handsomely. It's all about being disciplined and having patience. And so, What are my key things that I think you should be considering right now? If you are a first time investor, you've only just started, and your thought has been quitting stocks over the last week or two when markets have been really, really volatile. I mean, I'm holding quite a lot of stock at the moment that are actually down. I mean, it's not nice, but that's not been my only strategy holding individual stocks. So, what are some of the key things for you to consider? Well, the first thing that I think that you really need to do is to perhaps just reevaluate what you've done to get to this point. And that isn't to say be negative in your approach, but to take stock of where you are and what you've invested in and how you've invested in it. One of the things that I think is really important for any first time investor to understand is the difference between speculative stocks and everything else. And when I say speculative stocks, I mean SPACs. I mean, SPACs have been all the rage through 2020 and even at the beginning of this year. So many have come to the table now. I mean, Churchill Capital is a prime example of a SPAC where people have just thrown a lot of money into it and I've seen their portfolios go into the minus. Now, that isn't to say that you don't go after speculative investments, but I think it's really important that you understand how you use speculative investments within your investment strategy in order to give you the value that you essentially need. And this really brings us into, portfolio construction. How do you, if you are going to manage your own investments, i.e., buying your own stocks on Trading 212, Free Trade, eToro, how do you gather a collection of companies, of stocks that will allow you to have a strong foundation whilst also speculating for the future? This is something that we don't get taught in school. And unfortunately, this is something that is commonly known within the industry that I work within because people take exams for them. However, in the retail space, this needs to be perhaps even taught a little bit more and made available to the general public. And I hope that these following tips are going to help you. So first, you need to understand the difference between a speculative stock and everything else. A speculative stock is a high risk stock. It's stock that you can lose money on. Unfortunately, many people have gone into speculative stocks thinking they're going to shoot the lights out, looking for short term game, not really understanding that it is very much a long term play, particularly with speculative stocks. So, what other options do you actually have? Now, unfortunately, if you're looking at constructing a portfolio and again, buying shares, a collection of shares that you're going to be invested in, then you really need to be considering how you give yourself the best foundation. And the companies that are going to give you the best foundations are unfortunately the non-sexy ones. They're the ones that are not in the news. There are the companies that have been around for such a long time that they don't make a lot of noise, but they are consistently working and churning over cash, providing value to their investors. And you look at the likes of Warren Buffett. He is a value investor. He looks for companies that have high revenues, high turnovers in terms of money coming through the business, who are highly profitable, who are paying dividends. Really, if you're going to be looking at building a portfolio that's going to give you a strong foundation, those are the companies that you need to be looking at. So the Coca-Colas, Disney's of this world, Johnson and Johnson, those are just a few. Those are the kind of companies on which you want to build your foundation to allow you to speculate even further with the likes of Churchill or Healthier Choices or any number of the SPACs that have come online, or perhaps stocks that are still either categorized as speculative or growth stocks. You need that foundation. So the first thing you need to do is to understand that and perhaps review where you are right now. If you've come into investing and you've gone purely speculative, review it. Are you really happy to take that strategy moving forward? Or does it make sense for you to have a cohort of companies that are going to give you the foundation that you essentially need? I don't know the answer to that question. It's your portfolio. You need to ask yourself that. But I think this is a key consideration that you need to bear in mind moving forward because, frankly, guys, things could get really, really choppy. Things could get worse from here on out. And it's really important that you're prepared and you protect yourself, you manage your downside risk as much as possible. And the last thing is to just reiterate the markets will always be good over the long term. Whatever you're experiencing now, just remember it is going to be a short term thing. It may take a while for the markets to recover. The crash back in 2007, 2008, it took us about 5 years roughly to recover. I'll do a completely different video on market cycles. But you have to ask yourself, what are you doing this for? What are you investing for? How long are you investing for? Are you investing for 3 years, 5 years, 10 years, 20 years, 25 years? Because depending on how long you're investing for, your journey is going to be different. The companies in which you invest in will be very, very different. How you invest will be very, very different. I've not even started to talk about the benefits of using index funds and ETFs over buying individual stocks. Most people have come into investing over the last 12 months using trading 212, free trade, eToro, because they want access to individual stocks. And yes, whilst it's great that you can access these at zero commission and you can buy fractional shares in these companies, your risk level is really sky high versus using something like an index fund or an ETF that will give you the ability to diversify your investment risk because you're buying a basket of companies. So, for example, with the S&P 500, 507 companies, or with any one of the Vanguard ETFs, over 1,000, 2,000, 3,000, in some cases, even 6,000 companies to diversify you. Looking at global reach. This is a common mistake that most people make. They will buy everything in the United States. Yes, it's a nice place to be. However, you need to think globally because, again, it's about reducing your downside risk. But, guys, I hope that you found that useful. I know that I've covered quite a bit, and honestly, a lot of my previous videos go over some of this stuff to kind of bring this together. Please go and have a look at those videos in the Investing for Beginners playlist. If you want a place where you can literally access this information all in one place and it's nicely put into a coherent, easy to understand format, then my course is a really good place to start. It's only $59.99. You can take it on your own self-taught, finish it in about 94 minutes and get the understanding that you essentially need. But if you are thinking about quitting stocks, just remember this is a long-term game. You have to be patient, and ultimately the markets are going to come good. I appreciate your attention. If you've not listened to the podcast this week, there it is right there. Guys, have an amazing weekend. And remember, money is a tool, life is for living. I'll catch you on Sunday for the live Q&A with the guys at Marketplace Superheroes, and we're going to be talking about Amazon FBA. Take care.